Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Liquidity Risk in Investing, What You Need to Know. The 2008 Financial Crisis. The 2008 financial crisis is a textbook example of liquidity risk at its worst. Banks and financial institutions found themselves unable to meet their short-term obligations. Imagine trying to withdraw money from an ATM, but suddenly, the machine is out of cash. That was how it felt for large financial firms during the crisis. Here are some key points. Bank runs. People rushed to withdraw their money, fearing banks would collapse. This made the liquidity problem even worse. Frozen credit markets. Lending between banks dried up. Companies that relied on short-term loans to fund their operations found themselves in a bind, which led to layoffs and cutbacks. Asset fire sales. To raise cash quickly, banks sold assets at steep discounts. This further drove down asset prices and worsened the crisis. Investor behavior changed drastically. Confidence plummeted, and many pulled their money out of the stock market and other investments. They turned to safer, more liquid assets like cash and government bonds. Recent market volatility. The COVID-19 pandemic brought a new wave of liquidity risks to the forefront. Businesses suddenly needed to adapt to a world in lockdown, and investors had to navigate a highly volatile market. Several factors contributed to this. Rapid market swings. Stock markets saw wild fluctuations. One day stocks were up, the next they were down. Investors were unsure where to place their money. Increased redemptions. Mutual funds and ETFs faced increased redemption requests. Investors wanted their money back, leading to liquidity stress for these funds. Government intervention. Central banks and governments stepped in with stimulus packages. This provided a liquidity cushion to financial markets, helping to stabilize things somewhat. Investors learned to be more cautious. Many started keeping a larger portion of their portfolios in liquid assets. The pandemic reminded everyone that liquidity risk is not a thing of the past, it's a constant companion in the world of investing. Understanding these real-world examples helps paint a clearer picture of how liquidity risk can influence markets and investor behavior. We've covered a lot of ground on liquidity risk in investing. Now, let's bring it all together. Understanding liquidity risk is not just important, it's crucial for any investor who wants to see their portfolio grow without unexpected hiccups. Summarizing key points. First, remember the basics. Liquidity risk is the chance you won't be able to buy or sell investments quickly without impacting their price. It's different from other types of risk, like market or credit risk. Here are the key takeaways. Liquidity types. Market liquidity. How quickly you can buy or sell without affecting the price. Funding liquidity. Your ability to meet your obligations without selling assets at a loss. Assessing liquidity. Look at trading volume. Check bid-ask spreads. Examine past price movements during market stress. Managing liquidity risk. Diversify your portfolio. Keep an emergency fund. Invest in highly liquid assets like blue-chip stocks or government bonds. Why understanding liquidity risk matters. You might wonder, why should I spend time worrying about liquidity? Picture this, you're driving a car. Market risk is like traffic on the road, tough but manageable. Credit risk is the condition of your car. But liquidity risk? It's the gas in your tank. No matter how good your car or how clear the road, you aren't going anywhere if your tank is empty. Understanding liquidity risk helps you avoid getting stranded. It's not just about staying in the game, it's about playing it well. Informed investors make better decisions, and knowing the ins and outs of liquidity gives you an edge. Encouraging proactive management. Now that you get the importance, what can you do? Be proactive. Don't wait for a crisis. Act now. Review your current portfolio. Identify which assets are liquid and which aren't. Set up a liquidity plan. Know what steps to take if liquidity becomes an issue. Stay updated. Markets change, and so does liquidity. Keep an eye on market conditions. By being proactive, you're not just reacting to changes, you're anticipating and planning for them. This approach can help you navigate the complex world of investing with more confidence and peace of mind. Understanding and managing liquidity risk is essential for any investor. Think of it as a skill you can master over time. The more you know, the better prepared you'll be to handle whatever comes your way. Keep learning, stay nimble, and invest wisely. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.